FuruRadio is on the future of AMM. So I think everyone if you use DeFi, you've probably used a swap or you've probably used an AMM. It's a crucial part of our industry and of DeFi in general. So it's really interesting to kind of see where are we headed with this kind of protocol and what's the future look like. So we're here today with Tyler from QuickSwap, Munir from Paraswap, Julian from ApeSwap, and Leo from Dodo to kind of talk about this. So maybe you guys want to just jump on and provide a brief introduction. And if you haven't followed on our radio before, it's kind of like an open chat. We do have some questions to facilitate the communication between you guys and kind of open up the discussion. But feel free to talk as much and or as little on any topic. And if you go a little bit off topic, that's totally fine. It's just to facilitate the conversation between you guys and discuss the topic as a whole, which is the future of AMM. So maybe Julian, you want to introduce yourself first and tell us a bit about ApeSwap and kind of what you guys are working on.
Awesome. Sounds great. Yeah, so my name's Julian. I'm Director of Business Development over at ApeSwap. And ApeSwap is actually a decentralized exchange / DeFi hub that was launched in February 2021 on BNB chain. And since then, again, we kind of started with the DEX in order to get ourselves on the map and start acquiring a community in TVL. And then since then, we've really branched out into trying to become as much of a hub as possible. And what I mean by that is, we've developed kind of an ecosystem of products that all fall under our umbrella, including a lending network, a bonding protocol, a launchpad, of course, the DEX itself, and some NFT initiatives there as well. And really right now, our goal is to, really be mindful of the kind of traditional liquidity mining programs that have existed and for the better part of 2 years now or a little bit more, and start kind of trending in the direction of sustainability, lowering token emissions, and generally setting ourselves up to be kind of this central hub where new users and power users alike can tap into a comprehensive DeFi ecosystem.
Awesome. That's great. Thank you very much. Tyler, did you want to give it a go next?
Yeah, for sure. So I'm Tyler, head of listings at QuickSwap. QuickSwap's a decentralized exchange built on Polygon. It was launched November 2020, I think 2020. I always get my years mixed up. But we're a fork of UniV2, so we use the same model. And right now we're strictly on Polygon just to try to keep the community close and to keep our token emissions on one chain. And we're actually launching a new website today, and then we're doing a V3 like very soon in the next couple weeks, just because we think the V2 model is nice, but of course with Uniswap V3 out, like you can be a lot more efficient with the liquidity, and I'm sure we'll discuss that more later. But yeah, basically we're a DEX on Polygon.
Awesome. Thank you, Tyler. Leo, you want to introduce yourself?
Hello, I'm Leo from Dodo. I'm a researcher at Dodo right now doing strategic research and project researches. So Dodo is among the first to use proactive market making, which is basically managing your liquidity in a professional way through algorithms. And right now, Dodo is available on more than 10 different layer 2s and of course Ethereum mainnet. And all those different, by saying layer 2, I mean also including the other EVM compatible chains. So we're not only a proactive market maker like exchange, we are also a aggregators. We aim to provide the best rate on the market for any exchanges. So if you haven't given it a try, please do, and see if you find the best rate. Thank you. And yes, in addition to that, we are also trying to expanding to provide more EVM compatible DEX services, exchange services, and also we are considering horizontal expansions into other fields, including different NFT space and also here and there. But our main focus would still be optimizing for users in exchange, like 1inch, if you're familiar with that.
Awesome. Thank you, Leo. And then Munir from Paraswap.
Yeah, hey guys, thanks for having me. So I'm Munir, founder of Paraswap. Paraswap is a decentralized exchange aggregator. We are present in various chains and launching new chains very soon. You can think of us as like the Expedia or a Kayak to find the best price among these amazing panelists. So you use Paraswap for the same reasons as you would use an airplane ticket aggregator to get you a price that's the best price in the market actually. But in the context of DeFi, the value proposition of an aggregator is to give you a price that's better than the markets. So that's why you would use Paraswap. And we also recently launched an NFT swaps, peer-to-peer swaps. That's a new product built on top of Paraswap that allows any user to trade NFTs or any marketplace to allow their users to pay or to buy, or sell NFTs and expect any token to be used on the counterparty.
Awesome. Thanks, Munir. So thank you very much to the four of you for being here, and thanks for everyone for attending. So we'll kind of just get right into it. Feel free to jump in, discuss the topic, or anything related to it, basically. So the first question is, most AMMs today are still following the Uniswap formula. Is this the most capital efficient method? Is this the best method? Is just this the first iteration before kind of we make advancements, or what do you guys think in terms of, I think the majority of platforms are still using the Uniswap method, probably, I don't know, 85% or more of them. What's your guys' thoughts on that?
One of the big reasons for us, and I'm sure for others, is it's so easy to stake like Uniswap V2 LP to earn rewards either from like QuickSwap or ApeSwap or from the native platforms. UniV3 and some other models, like UniV3, for example, gives it an NFT, and each NFT has a different value of like the two tokens that are going to be traded, and they have different price bands. So it's basically almost impossible to like be able to stake that and earn rewards, because people will find like the most efficient way to optimize their LP to get the rewards. And UniV2 is like fair for everyone, whether you put in $100 or $1 million. Like it's still the same ratio of tokens, and you still have the same percent allocation of the total. So that's actually one big reason, even though it's less efficient than like UniV3.
Yeah, and to add to that, I mean, we're honestly, ApeSwap is in a similar boat as well. We've obviously been really keeping an eye out for all the developments that have been happening in the DEX space as a whole, whether that's concentrated liquidity or kind of, moving away from traditional liquidity mining services. And yeah, I mean, from our perspective, there's a lot of different paths that can be taken. And we've really just been kind of on the sidelines for a bit and ideating as much as we can on what's already coming out right now and what other builders in the space are doing. But really just being mindful of kind of overall product direction and ensuring that any of these major changes that we are planning to make are kind of really long-term minded, and obviously going to position us and really set ourselves up for success over the long term. And so part of that, I mean, for us, we've been really looking at balancers tech lately, which has been pretty interesting. And yeah, we should have some more coming on that pretty shortly, actually.
I believe also simplicity is part of it, since Uniswap V2 is one of the simplest formats of AMMs. Prior to Uniswap V2, I mean, Uniswap wasn't actually the one who invented the AMM model. It was done by Bancor a few years before. And Uniswap came as an improvement or like an upgrade on the user experience side in terms of the LP or the traders. Traders for its gas efficiency and LPs for its very simplicity. And I think it the open source part of Uniswap allowed many other protocols to bootstrap and get the user base. And as we're here right now, that was just a phase one. And next steps for, I imagine, the major decentralized exchanges is to move into a better model, as Uniswap did with V3. So we're going to see many V3s. And this time, I guess those will be quite different and quite custom made for users of those dexes.
I think we are seeing a trend to move from the Uniswap V2 to a more complicated model where we're just trying to improve capital efficiency on that. But besides, on the liquidity part, liquidity providers are moving towards more professional liquidity management because they found out active liquidity management would be better than passive liquidity staking. So in that case, in that case, so I don't think it's the formula that itself is making it inefficient. I think it's more of like the way you're managing, you know, on top of that formula is making your capital efficient. And I would agree that, Uniswap V3's NFTs would not make it DeFi compatible, but in a sense, it doesn't necessarily means it's capital inefficient because you can still integrate with Uniswap NFTs and also have ranges designed for users to stake with, right? But at that topic, it is a little bit harder to integrate Uniswap V3 LP tokens on that sense, and which making it a little bit less efficient in terms of derivatives and yield generating. But overall, I think we can see this moving to the professional realm that potentially make you more money, and moving to this more complex model where helping the users to be able to have as competitive as those professional market makers, right?
I completely agree. I really think, I mean, the main reasoning right now for most players in the market is the simplicity, as others have stated. And I think, I mean, it's the same reason why we saw, Uni V2 up ahead of Uni V3 for such a long period of time in terms of volume. And I think it just comes down to, the tech was so innovative and new to so many people, including, the kind of bigger players in the space that would come in and drop significant amounts of liquidity. And I think, now that people have had a chance to really dig into it, how it works, test things out, we are actually seeing the full promise of Uni V3 kind of unfolding as they are now, really dominating the DEX volume in the space at the moment. And so, yeah, I couldn't agree more, Leo. I think we're going to see a lot more transitioning into the kind of Uni V3 model, or even hopefully iterating on that as well.
Yeah, that's an interesting point. And I guess the point is that as more tools become available, maybe automation tools, ways to manage your funds in an active way, or even in a passive way, that these new systems become more efficient, and with more efficiency, comes maybe more opportunities to generate value, right? So I guess as these things become more mature, then that's where we're going to see things going. So, I mean, we talked a little bit about it, but that's kind of segueing into our next question is, what is, with the advance of Uniswap V3, we haven't seen a huge amount of change in platforms integrating that, although it sounds like, most people are looking into that. QuickSwap is doing that shortly as well, integrating into a V3 format. So I guess also Tyler mentioned some of the concerns around the NFTs, but what are some other concerns with the system? And then, what makes this new system more capital efficient for those who are unaware of what the upgrade is?
One of the biggest concerns with both like Uniswap and other concentrated liquidity is just the user experience, and it's much more complicated to create an LP versus Uni V2, where it's just, hey, have the same dollar value of these two tokens and put them together, and that's it. Well, that's like now you got to choose the price bands on like at what price will all of the one token be sold to the other token, which I know an article came out and like a month after UniV3 saying that like 85% of the LP stakers lost money, or not LP stakers, but people that made LP lost money. So people are afraid to actually use UniV3 because like it with UniV2, you always have like the same USD value of the two tokens, but with UniV3 you could lose all of one of your tokens if the price band hits. So that's one thing people get upset with. They're like, why is all my ETH gone? It's like, well, because you didn't fully understand what you were getting into. So that's one thing we really want to look at. And with RV3 coming with algebra, that's one thing we want to do is like make sure people are educated before they actually get into this, and they know like it's a lot more capital efficient because I don't know, it's kind of complicated. I'm not a developer. I don't want to say something wrong, but basically more swaps can go through with the price bands. But I mean, to answer your question, the biggest thing is going to be user experience. We don't want people to get into this that don't know how, and then they just create FUD, and then say how much money they lost and stop using it.
Yeah, I completely agree. I think the concern lies into more of user not understanding enough that they are entering a leveraged position when they provide limited liquidity or range liquidity to the pool. And in that case, I don't think it's Uniswap V3's fault to not able to explain those things because I seeing those realms going more professional liquidity providers will require more options in a decentralized exchange platforms like Uniswap, and that is what I see why Uniswap V3 gives all those options to the users. But it's just the difference between professional traders and the normal traders, and the education gap there when Uniswap V3 first came out is like huge, right? Because as a professional market maker, you would understand all those different scenarios, different excuse me, excuse me, still under COVID influence, but you would be able to understand all those variants, all those risks that you are leading into. But as a normal user, you would just say, hey, this concentrated liquidity sounds good, and I will just try to put my money into it, earning like 10 times or 8 times or whatever times the amount of yield, but not realizing the permanent loss involved with it would be able to destroy them in just a smaller variant, right? So in that case, I would think the new system generally is much more capital efficient, but it increases, the interest barriers, and which is completely fine as the trend of moving towards professional liquidity providers.
100%. I think what was interesting though with the UniV3 launch is they really framed it up, and I mean they did put effort into the docs and everything, and trying to get people up to speed with the tech, but it did feel a little bit like they were pushing a lot of kind of buzz terms of like up to like 100x the capital efficiency on your liquidity and stuff like that. That kind of, I think, probably going back to what Tyler was saying, probably led to a lot of these retail investors losing some significant amounts of funds early on in the launch of UniV3, just because there was so much marketing being done around how much more capital efficient it was, and less so about how the actual tech works and kind of the dangers and pitfalls of it. That I think that's kind of what happened to a lot of those users there, and kind of led to the dominance on UniV3 by actual professional market makers and such.
And that's another thing to note is to use these concentrated liquidity models. It has to be active. It's not passive like V2, because once you set the price band and the price of the tokens outside, like you have to go back in and redo it, or like as the band's getting closer, you have to pull the LP out and get a new one. So people don't really want to do that. That's why they like V2. You could just set it and forget it. So yeah, it is for more professionals.
Great, great. Yeah, that all makes sense. So I guess with that being said, it sounds like there's still some, barriers to entry. Do you guys see the V3 model kind of taking over, or like depends on the tooling, or do you see most protocols just sticking with V2 because of the user experience and, not having to actively manage it, or the risk of, a large and permanent loss if you get outside of the price bands?
I think what's going to lead to a lot more adoption on the Uni v3 front is, these kind of middleman protocols that are able to position themselves as kind of liquidity managers for the people that are entering positions on Uni v3. So I feel like, really just tooling, like you mentioned, I think is going to be the main thing that allows more retail investors to be able to participate in these Uni v3 models, as well as protocols to feel comfortable to kind of make that jump into these V3 models. Again, knowing that most users and as Tyler was mentioning, like the community as a whole might not be so familiar with this and kind of prefer to trend towards that simplicity and ease of use. So I feel like it really does come down to tooling and giving people easy access to different techniques and just ideas of how to manage that liquidity in a way that allows them to kind of set it and forget it, more alike the V2 model.
And that sounds a lot like the proactive market making strategies Dodo is currently using, because it's as if it's managed by your target and automatically balance your two sides of liquidity in a price fluctuation models. So in that case, like we are seeing this trend of moving into proactive market making realm where it's just similar fund management strategies that excuse me, that's more active and more reflective to the current market.
Cool. So I guess my last question on it is Uniswap V3 the most capital efficient, or is there a more efficient method, or is it, we see V3 and kind of the leverage of the liquidity, and that's kind of the end goal, or is there something different, or a more effective way of doing things? What's your guys' thoughts on that?
But I think in technology, the point of innovation is to always bring something better than what it used to be. So each version is an upgrade of the previous one, and the sum of the learnings that any DEX have learned from the feedback they got from their users, and that's we can trace. I think in all versions of Uniswap, the first one started with just a token to ETH, which didn't make that much sense, but it was based also on the experience of Bancor that was building everything on BNT. So then it led to having a token machine to V3 for capital efficiency. And now I think with Dodo, PMM, and other kinds of structures or architectures of liquidity that we will see. So I don't think Uniswap VT is the ultimate innovation that we have in the space, and I guess also Dodo has a great model as well. Maybe you guys will say more.
I completely agree. I mean, oh, sorry. No, please go.
No, you go ahead.
No, I just wanted to say, I mean, I completely agree. I feel like, this space is all about innovation and kind of bringing new things to the table. And, it's been such a short period of time and kind of the history of AMMs and DEXs as a whole that I feel like, proclaiming any specific model as kind of the end all be all is probably a bit too early at the moment. And frankly, I'm excited to see what the next developments will be and how new protocols in the space will iterate.
So I would say the initial banker model, where everything has a going to one single token, is is a bit more efficient in a sense where you're seeing all those liquidity concentrating to the token itself, right? But the problem would still be the impermanent loss part, because you're exposed to more of the risks involved in the two trading periods that you're creating, or in the one-sided trading period that's automatically experiencing three tokens risks, right? But at the end, concentrating liquidity is not necessarily bad, and I think it's like right now the one of the best models in the liquidity management realm, and that's why I think Uniswap v3 is really providing this efficient method that's helping liquidity providers to be able to make the most out of it. But um, on the other hand, while Uniswap v3 is improving capital efficiency, they are taking away some of the traditional, x times y equals k. That traditional Uniswap V2 model in terms of their profit, right? Because the liquidity concentrating, which means the depths in the middle are bigger. So for some of the users, some of those less riskier users, they are experiencing less income as a result of that. So would you say that's more efficient for those users? Maybe not, right? But it is more efficient for generally fund usage, given that you can leverage your fund in a short span of price range, right? So, like if we all consider the idea of being able to leverage your fund being as high as you can is more capital efficient, then Uniswap is as efficient as it can be. But in generally speaking, like in a general investment ideas, it's it's still the same, and rather it's taking away this capital efficiency from normal users.
The most efficient thing for the user is just the centralized order book, just like centralized exchanges, like traditional finance has been doing. I mean, it's like, hey, I have 1,200 USDC. I want 1 ETH. Very cheap, very easy. With all these liquidity pools and these dexes, it's the simplest way they've gotten to fix the problem. Because to have like a centralized like limit order book, I mean, Ethereum's like 15-second blocks. It can't facilitate trading like that. And then every time you want to put an order in or accept an order, you have to do a transaction, which would be crazy gas fees. So that's basically why Uniswap was invented. And how they got around that was like, hey, we have this big pool of liquidity of these two tokens. If you put tokens in one side, it'll imbalance the pool, so it'll spit tokens out the other side into your wallet. I mean, that's not as efficient as like person A has money and wants to trade with person B. I mean, that's why centralized exchanges have way more volume and it's a much easier user experience. But of course, the downsides is the centralized. So I know Binance tried this with their first Binance chain. I forget what they called it, but it's like very high frequency, meant for order book model, and it just never took off. I don't think it was EVM, but then they came up with Binance Smart Chain, which is a lot more usage. Yeah, it's it's the trilemma problem.
Yeah, I think I want to facilitate on that trilemma. It's like, basically decentralization, impermanent loss, and capital efficiency, right? Including like increasing capital efficiency in a decentralized world, like most likely means higher impermanent loss, just like the Uniswap v3 is, doing. And I mean, like, so as we're looking at this decentralization problem, is decentralization really important? Well, in the case of blockchain, they might be important at the beginning, but right now we're seeing a centralization of the entire blockchain ecosystem, where we're seeing more centralized protocols being developed, or semi-centralized protocol being developed, and we're seeing more of a centralized DAO governance with um, major token holders was able to decide the entire fate of a decentralized protocol. And like the question really would be, do we really need decentralization in the AMM space, and why do we need decentralization in the AMM space, right? But all to the end where the initial automated market making happened, where the impermanent loss was introduced and the capital efficiency was, okay, but not so great. People accepted that. People take that idea and they like, hey, centralized exchange has risks, has a lot of risks, as we are seeing in the bear market, and that's why decentralized exchange is able to stand out in that kind of market, right? In that kind of competition, especially.
Yeah, and with the risks, with like impermanent loss, for example, no one would put in any LP if there's no yield on it. Like, hey, you can facilitate trading for this pair, but if no one trades, you're just going to lose money to impermanent loss. So no one would provide LP. So now you have to come with a fee model where the users have to pay a fee to the people providing liquidity, so that it's worth it for them to provide it. And Uniswap chose 0.3%, which is pretty hefty compared to like traditional finance or even centralized exchanges. I guess that's what they determined was the fee that people would pay. What, like they still wanted to trade, so they'll pay that fee, but it's not too high where it will like hinder trading. So I mean, and then that's how the users provide LP. They get the yield from the traders. So yeah, I think there's gonna be a lot of stuff coming out. And like you said, with the more centralized blockchains, there's definitely gonna be a chain coming out soon, or something where they're gonna have the order book model. Like maybe Binance will do it, where it's like an on-chain Binance, and of course the chain's gonna be like very heavily centralized, but it's gonna be more of a proof of concepts. Like, hey, this is like the first company doing all of their like tokenized business on chain, so you could see like the order flows going through. It's not just gonna be one big fat cold wallet where Binance has like $10 billion of Bitcoin or whatever it is. It's like the users still have the money, but it'll be on this very centralized chain, and if they want to, they can take it off the chain.
One example for that is the DYDX, right, with the new Cosmos chain.
Yeah, exactly.
I mean, if we see centralized chains, are we not seeing all those L2s are still centralized because they haven't really opened up their their entire block production process? So it's just like the only thing probably like decentralized enough right now are those like major L1s like Bitcoin, Ethereum, as we're seeing. So it's probably like I would think DYDX made the right move, but probably not the best environment in terms of their choice, right? This is just my personal opinions on that, but excuse, excuse me. But we're seeing we're seeing this, like we're definitely seeing this shift, and I think this will be like what we will see more in the next bull run, right?
But I think also it comes down to defining decentralization in that context. Is it about the whole stack being decentralized, or the custody where the end user end up always having control of their funds, but maybe the platform is not maybe permissionless or like less censorship resistance, but it's still non-custodial and users still are in control of their funds.
Right. But there's just a different way of centralization, and you all face that one censorship, to just manipulations on top of that, right? So it's to the users. Maybe a lot of users don't care about that, but if you are like firmly believing the decentralization, the permissionless nature, then like any of the centralization would just be sort of unacceptable to them, and just to them, they really want to own their own money. They really want to have this censorship and manipulation resistant idea on top of their money. Then it's just like only those big chains that will satisfy for them. But I think we're little bit deviated from the main topic, right, at this moment. So let's stop here.
All right. Cool. So, yeah, I mean, you guys basically talked a lot about it already, but kind of one of the biggest issues for stakers and farmers right now, especially depending on their tokens and the way, the market's going and the reduction in like staking rewards is kind of like around impermanent loss. So, if I can stake my tokens for 15 or 20%, it might not be worth the impermanent loss that I'm going to get from the divergence in the price of the token. So, I mean, I guess that kind of goes around, strong pairings and stuff that is being offered by the dexes. But what's your guys' thoughts on kind of impermanent loss? I guess related to the bear market at this case, because that's kind of where we're at right now. And how do we minimize this? Is it around again active management or tooling, or is impermanent loss just not a problem that people think it's not as big as a problem as people think it is?
I think in the bear market right now, what we're really facing is liquidity issues, where those various altcoins, they don't have enough liquidity to support their price range, where those bigger ones, they move together because they have a very interconnected liquidities. So in terms of that, you would see like an altcoin easily goes down 90%, but you would not see Ethereum easily goes down 90%. So in that regard, investing in a liquidity pool where Ethereum matches with altcoin would not be would not be any good, right? So like my idea would be investing into pools with similar, like two sides of the pools with similar liquidity, where um, you would be able to manage the market as the entire market goes down. You still being able to balance out your impermanent loss because they both are going down in the price. And also, one of the trend we're seeing is liquidity concentration to those to stable coins, to Ethereums, to those big higher liquidity tokens, because like right now we have various different routing strategies to help getting the best rate, right? And in that sense, like those trading volumes would also be concentrated in those major liquidity, big liquidity tokens, where like all the profit are shared by those like concentrated liquidity pools, where uh, like just seeing this trend, I feel like it's not worth, it really not worth to invest in any of those altcoins liquidity pools, which will most likely result in huge impermanent loss. But I mean, the demand is there, right? When the time is fit, when the profit loss model is fit, um, it could be opportunities, but it's great risk that I don't recommend anyone that's not professional to take at this point.
Yeah. To add to that, we see, at QuickSwap and I'm sure other exchanges, pools like Matic, ETH, LP, or like ETH, Bitcoin, coins that are pretty highly correlated. Users will accept a lot less yield on those because the impermanent loss is a lot less. And I think overall, with pools like that, impermanent loss, it's not a huge deal as long as you're staying in the pool for a long time. Like if you get in one day and Polygon tanks, but ETH stays stable and you pull out, like of course you're going to get hit with permanent loss. But when you think about like long-term yields from trading fees and like token inflation from staking that LP, like you usually get more back than the impermanent loss. Where the impermanent loss is a problem, like Leo said, is the like altcoin USDC pools, where the altcoin might go 10x, 100x, or might go down 90%. Like you're going to hit huge impermanent loss with that. And that's why when users get into the LPs like that and stake them, the yield is usually like hundreds of percent from staking and from trading fees, because people don't like getting in those pools from the loss. So you have to heavily incentivize it. Usually the project heavily incentivizes it because they want people to provide liquidity. So yeah, it's really like free market. It's really like your risk appetite. If you want super high yields and you know you're going to hit with impermanent loss, like you could take that risk and hope that the yields is bigger than the impermanent loss. Or, a pool like Matic ETH, where the tokens are very highly correlated and there's going to be decent volume, but you'll just earn less yield.
Yeah, I guess too. There's kind of a trade-off with impermanent loss and liquidity. As more people are pulling out of the pools, there's a higher propensity to earn based on the liquidity, right? So you're going to get more of the trading volume from the pool. So I guess at some point, if everyone's leaving, it's more efficient for you to jump in and earn on those trading fees, right? So, and then obviously protocols like Munir's Paraswap kind of facilitate that a little bit more if people are using the aggregators and its funds are kind of more efficient in the way that they're being routed, right? So, yeah, I think that's very good points. Cool. Any closing thoughts on that, or?
I want a nice cross-chain DEX that uses pools from like every chain, maybe even loops in, like, I don't know.
But
There's a lot of people build.
speaking of that, I saw this hackathon project on East and West Sea where they build based on one each, but making a cross chain with hop protocols. It might be worth looking into it. Let me try to remember the name. But it was just
Yeah,
the
I've seen.
idea
There's
of having
Wi-Fi. There's
like
a few I've been looking into, but like the user experience just isn't there, and it also, I mean, it's really weird when users like, oh, I want to trade, and like maybe trades better price on a different exchange, but if you use Hop Protocol, like you're not going to get those tokens for 20 minutes, and in that time the
right.
price is going to change so much. I don't know how it'd be done, but it's just someone's going to build it.
Uh-huh. Uh-huh.
Yeah, no, for sure. And I mean, that's a perfect segue to the final question, which is basically what's the future for AMMs and, how are you adapting to these changes? What are the overarching goals here? And just to kind of add to what Tyler was saying is, yeah, the cross-chain swapping stuff is pretty interesting. And I think there's a few protocols that are looking at doing kind of capital efficiency across chains. I think Aave v3 allows you to borrow across chains through like their liquidity pools. So it's going to be interesting to see how that gets facilitated. But yeah, I mean, I was looking into some cross-chain swapping and how it's done. And, Tyler, you make a great point. It's the biggest barrier to entry that I found right now is the time, right? It's going to take you, 3 to 15, sometimes 30 minutes to get your token across on a different chain. And if you're, running a system of bots or you're looking for arbitrage opportunities, that time factor is going to be huge for you, right? So if you can find a way to do this cross-chain swaps, while reducing this time factor, I think that could be the kind of the huge breaking point. And like, I don't know if you just kind of would you would do the swap on the one chain and facilitate it on the next chain while, not waiting for the transaction to execute or finalize on the initial chain, if that's kind of the key, right? You deposit into one pool on the initial chain and maybe pull from a separate liquidity pool that's on the other chain before the transaction kind of executes on the initial one, just to facilitate that instant transfer. Or if there's some kind of other way to do that through like call contracts or what, I'm not sure. But, that's, I think, kind of going to be the biggest thing right now is dealing with that time factor.
And what you said with Aave v3, I mean, one thing you could do is like lend USDC on Polygon. Like let's say I want to trade USDC to Bitcoin, and the price is a lot better on Ethereum than Polygon. What the protocol could do is like lend USDC on Aave on Polygon, borrow USDC on ETH, trade, lend the Bitcoin on ETH, then borrow it on Polygon, put it in the user's wallet, like all in the same block. I guess it'd be like 2 blocks, 1 block Ethereum, 1 block Polygon. I mean, then it would be instant. So yeah, I mean, someone's gonna build something like that. And the QuickSwap, like Polygon's very cheap, very fast, very easy to use. There's a lot of liquidity. The reason why we're building on Polygon is because like the future is going to be, I don't know if you want to call it cross-chain, multi-chain, but you know, if QuickSwap and with our V3 we're going to have like super low fees, there's going to be a lot of volume routing through us. So that's why we're going to build like as efficiently as we can on Polygon, and we just like know people will integrate us, like things like 1inch or Paraswap.
Yeah, and I mean, just to add some of my thoughts on this, from an AMM perspective, I think there's definitely a few things that a lot of protocols are looking at the moment. And I feel like we've mainly been talking about capital efficiency, which, you know, I feel like everybody here is definitely, you know, aware of kind of the trends and how they're moving forward, as well as kind of thinking and ideating, or, you know, in the case of QuickSwap and Dodo, you know, already have their own systems or are working on those. But beyond that, I think another big challenge for AMMs at the moment, especially, you know, V2 style AMMs that rely on inflationary tokenomics in order to source liquidity, are just that, right? Is traditional yield farming and how, you know, relatively unsustainable it is, and how do we kind of move away from that model? And from our perspective, I mean, there's a lot of different ways that it can be done. But on our end, we're actually working on we've released a bonding protocol, very similar to Olympus Pro, but with a couple of additional twists and kind of building off their model. And the beauty there is, you know, we're really just trying to think of ways that we can kind of, again, like, you know, not rewrite the entire playbook, but really transition from our current models that, you know, we've realized are not necessarily the most sustainable, into a more sustainable model and overall kind of, you know, method of keeping the ecosystem thriving and growing. And so we're calling this rent to own, where essentially we're able to kind of leverage the initial, or, you know, yield farming to kind of bootstrap some initial liquidity there, and then tie that back to the actual bonding protocol in order to source, you know, protocol-owned liquidity, chain-owned liquidity, or, you know, actual like DEX-owned liquidity as well. And it's been pretty sweet at the moment, and we're pretty excited for what that's going to look like. But yeah, I mean, I'm curious to hear how other people on the panel are kind of thinking about. And I know we're not all in the same, I guess, situation of kind of relying on inflationary tokenomics, but definitely curious to hear how other people on the panel are kind of approaching this problem and you know, coming up with solutions to kind of solve this.
Sorry, Julian. What was the problem again? Got distracted for a bit.
No worries at all. Yeah, I mean, so, you know, to give an example, obviously, you know, our protocol relies on Banana. It's our native token. And we emit a certain amount of Banana per block on BNB chain in order to incentivize liquidity on the platform through traditional yield farming. And this, you know, obviously was a great, you know, very innovative model early on, but now, again, you know, we've understood that it's not necessarily the most sustainable model. It leads to, you know, decreased price of the token itself. The liquidity is not very sticky. You know, people, we're calling them mercenary farmers, really just come in order to provide TVL, acquire as many tokens as possible, dump them, and then kind of move on to the next place where the highest APRs are at. And so from that perspective, you know, we've really been trying to, or we have been ideating on this and coming up with more creative solutions as to how we can transition into more sustainable models. And I'm just curious to hear how other people are kind of thinking about this at the moment.
What we've done.
No, you go ahead.
Okay, yeah. What QuickSwap has done is basically it's like fee sharing of the volume. So we have right now on our V2 is it's 0.3% fee for any trade. 0.25 goes to the LP stakers, 0.04 goes to quick stakers, and then 0.01 goes to the QuickSwap Foundation. So, it's kind of like fee sharing is one way, and then the other way is we allow. It's very similar to the PancakeSwap model, where you could stake quick and earn project tokens, and we work with those project tokens to give them LP farming in return for them to launch a Sura pool. So that's one way we've tried to stop just the farming and dumping, like you said, of the governance tokens. But of course, that's always going to be there. People, if they see essentially free money, they will take it. So one way is to just be as efficient as possible with the token emissions. If there's a pool that gets no volume, but you're heavily incentivizing it, you kind of need to stop that unless you're getting something in return. So that's one thing is every token you emit, you should get the same value back, and that's one thing that projects haven't done great with. But in times like this, bear market, you need to be very, very careful.
I see the token model more as a initial kickstart, like liquidity attractions. But once they've done their job, and if you fail to acquire enough volumes, enough users, or even enough liquidities at the end, when the token starts to lose its power, then I would call it more of a failure at that point, because using token as accelerator is great. Is great in terms of incentivizing, in terms of starting a project, in terms of attracting liquidities, in terms of attracting users. But the token can only serve this long, and the later on, like excuse me, like Taylor said, it's really giving the value to the token reward, which means potentially being able to generate the equivalent amount of token, equivalent amount of profit for the token that you've given out as incentives to reach out a balance at the end, right? But I mean, at the beginning, it wouldn't be possible to reach balance, otherwise no one will come to you. But that's really the end goal in terms of balancing the token release and the token value, because you're accumulating value to from the platform fees to your token. But just but we still face various regulations in terms of how to avoid your tokens being treated as securities, and that's the problem that everyone's trying to deal with right now. But uh, I'm seeing the value exactly in that, where the token at the end would be able to be a balancing role in the ecosystem.
Love it. So I seem to have gotten kicked out there at the beginning of those responses, but I think I was able to catch both of them. No, that's great to hear. Yeah, super awesome. And Tyler, yeah, that's definitely the way we've been kind of managing our pools and farms, for essentially since launch. Obviously, trial and error in order to kind of understand this stuff and kind of realize, where's the value coming from and how do we kind of, I guess, close the loop in a sense. But even then, I completely agree. I think we're always going to see kind of that dumping behavior as a whole. And I feel like, there's only so much you can do at the end of the day to really properly close that loop and kind of avoid the pitfalls of traditional liquidity mining. So yeah, no, I'm excited to kind of see how other players in the space ideate on this and develop it further. And definitely encourage anyone who's interested to check out Treasury Bills and Jungle Bills. We're super, super excited about this whole initiative there.
Yeah, and I guess to kind of close on that, as things become more efficient, you're able to provide less inflation on your token and maybe less rewards in terms of farming incentive, as things are kind of maturing in the space. So I think, as Leo said, it's kind of used as a bootstrapping, and then hopefully as things get more mature and the market turns around, that's you have to provide less incentive. Obviously, as your token price goes up too, that you can continue to rebalance that and have less inflation on your token as well. So I think that's very interesting thoughts. We're getting near to the end here. Does anyone have any closing thoughts, or we can kind of wrap it up from here otherwise? No? Okay, cool. Well, thank you very much, Julian, Tyler, Munir, and Leo for being here. Definitely, feel free to shout out your Twitter or your protocol again. So Julian's with ApeSwap. You can go there obviously via apeswap.finance. Leo's with Dodo. You can visit Dodo. It's dodoex.io. QuickSwap is quickswap.exchange, and then you can visit Paraswap via paraswap.io. So thanks again, everyone, for being here. And of course, you can visit FuruCombo as well, and that's furucombo.app. So yeah, feel free to shout it out, and then we'll close the call here. So thanks again.
Awesome. Thanks so much for hosting this. By the way, this was a super interesting conversation, and definitely was excited to hear more of the insights from my counterparts here and their various projects. So no, definitely thanks again, and look forward to the next.
Thank you.
Yep. Thanks for setting this up, and thanks for having QuickSwap.
Thanks for the conversation, y'all, and have a good day.